Hello everyone, my name is Vikas Shukla, and in today's video I'm going to talk about how you could create your own business in kind of your insurance business using the stock market. So, to give you some perspective of what we are trying to do here, uh, basically, if you look at some of the insurance company, and you probably already know how they operate and how they derive their profitability, what we will eventually be doing is that we will act as an insurance company and we will insure a stock against a steep fall. So I'll get back to you how we would do it, and we will use an instrument called a put sell, which is a part of the option. If you do not know an option, selling options or buying options, I will walk you through this process. But before I go into that, I would like to you to understand how a insurance business operate and how you can create a profit out of it. Uh, I listed out some of those insurance companies. United Health, it's a U.S. largest insurance company. They had a revenue of $242 billion and a profit close to $13 billion, and its stock is valued as $301 billion. So not any more future growth, but probably good enough for a stable this thing valuation. Anthem, on the other hand, has $100 billion of revenue with $4.8 billion of profit and $69 billion of the market valuation. Allstate, car insurance company you all know about, or maybe a home insurance as well. They have $45 billion, $4.8 billion, and $30 billion insurance. So you all know that how a car insurance company, for example, works. So what they do have is they collect premium from maybe let's say 100 car owners, for example, and each one is paying let's say $100 each. So that means they collect $10,000 of premium every month. And statistically, if you look at this, because $10,000 per month is a big amount, it's a reasonably big amount, and there is a very little chance that one of the 100 car insurer will have an accident. And let's say that one car has an accident and the insurance company has to pay, that amount will typically vary between like $3,000 to $4,000 or maybe $5,000. Of course, in some cases it will like $2,000 to $3,000. In other cases, it can go high as $15,000 or $20,000, maybe $40,000. But on the average, that figure will be like let's say $6,000. And then let's say they have an operating expense of maybe another $2,000. So with the $10,000 premium that it collects, it uses that expense for its operating expenses to cover kind of communication and this thing, put up the infrastructure operations, and it has a $2,000 of profit. So that's how all insurance companies work, and they work reasonably well because of the statistically there are fewer incidents. Same thing with the health insurance. They collect premium from a family, typically like $1,500 every month, and then same thing they do with the hundreds or thousands or tens of thousands of people, and then few people get sick, and then they pay the cost of the health and their health and sickness and doctor visits and then or hospitalization. But because that is statistically that number works in their favor, they make the profit. What you can do is actually your all your revenue, when you talk about the stock market, then you ensure the things, you are having a revenue like this, but because your operating expenses will be very low, all the revenue, your profit margin could be much higher. And I will come back to what you are actually insuring against. You are insuring, for example, the car insurance company insures if some person, you hit someone's car unintentionally, and then that car owner, the other car owner or the person asks for any reimbursement. So you are insuring a stock against a steep fall. That's what you are insuring against. Someone else owns a stock. That stock can for some reason, some accidentally or some because of whatsoever reason, that stock has a steep fall, and then the person who's insuring his stock, because he does not know what can happen for that particular stock. The stock may go bankrupt. Maybe some lawsuit against that stock goes not in favor of that particular stock. So that stock, another reason, could fall. There may be the result, the quarterly results that it declares every quarter, that may not be perceived very favorably for that stock, and then that will lead to a very steep fall for that stock. So those are the cases where the stocks are going to be there may be a very steep fall, and that's the person wants to insure against, and then he pays a premium for it. Now I'm not talking about you are taking insurance for your stock for against a steep. I am talking about you are on the other side of the house. You are insuring those. You are the insurance company, and then all insurance company mostly make money. So you can also make money, and that's the thing that I am going to discuss in this video. So how do we do is with the instrument called an option sell, that called a put sell, and I will explain that put sell with an example, and I will have more data to show you my own profits that I've made using this strategy. And if you subscribe to this channel, I will at some point of time open up my own portfolio to show you how I have made profit from this by opening my insurance company, and how you could be profiting from them. So the key thing is that, to give you an example of sticker symbol AAL, what you could do is you could pause this video, look at this particular stock, what it is currently priced, and then you can come back and continue this video. So to let you know, American Airlines, this stock today it's $13, and then that price will change, but then the dynamics will change, but what I am going to tell, the content of it will still apply, but the figures may keep changing, or you can choose any other stock for that reason. Now this American Airlines at the moment we know is a volatile share, and we know because even though right now we are maybe slightly better after the coronavirus peak, the peak is slightly off then, but for some reason this coronavirus can come back again, or for some reason the stock is still in volatile stage. It has not completely come off this thing. So this stock can go further down. It has temporarily up. It was as low as $9, $10 recently, but it's temporarily up, but again can fall down. So the person who is holding this stock wants to insure against this stock, and what he does is he buys that put, and you are selling the put. What he does is he says that on August 21st there is a strike price of $11, and these are the terms you need to be aware of if you are into the put sell on option strategy thing, and this is the strike date. If that stock goes below $11, I mean, he is thinking of not $11, he is looking at it goes very steep down, maybe $9, maybe $5, something wrong happens, it's going to be bankrupt, it can go to like $1 or $2 share. So he is looking at on those figures, and that can happen very quick and very steep. He wants to be insured against it, so he does not lose his all money. So what he does is he pays 18 cents of premium, and his strike price is $11. So what happens if he's looking at, if this stock becomes like $9, then his stock gets sold at $11, and he pays 18 cents for this. So his effective sell price is 10.82. So that's what his strategy. Now you have to look at from your angle, and it's better to look at the other side of it, because I am trying to see how as an insurance company I am going to profit. So that's the angle from now onwards I will emphasize. What I am going to do is, my point is this: I use this American Airlines stock, $13 currently. I sell a stock at $11 strike price, and I get this premium. This is the premium I collect 18 cents. What my thinking is this, and let me see how I am going to profit. My expectation is that between now, which is August 7th, and August 21st, the stock may go down. There's no doubt about it. But there's very little chance that it will go down below $11 unless something catastrophic happens and something like that. And then this is my stock number one. What is most likely going to happen is the stock may stay maybe like $12, maybe $11.5, maybe $11.25, or maybe it will go up like $14, $15. That's what my thinking is, that most likely 99% chance is that it will not go below 11. It can by 21st August, on 21st August. And in that case, I earn those 18 cents in my pocket. So I get between August 7th and August 21st, those 2 weeks, I earn out of those $13, I make 18 cents. This is roughly 1.6%. Actually, slightly less than that, maybe 1.4% here. I will update it. Let me update it here. 1.4%, maybe whatever. And then that will be like 0.7% per week. This figure may vary a little bit, but don't worry about it. What happens is that my $13 are blocked. So I have to keep, actually $11. I think the earlier figure was right. My $11 are going to be blocked by my broker company. So after blocking $11, I make 18 cents, which means that my profit is 18 divided by 11%, which is 1.6% or 0.8% per week, which means in the month I am making like 3% or more per month, which is 36% per year. That's the big amount of money. Now what's going to happen? I use AAL, I insure AAL, one such company. Then I insure another company like this, which could be, and I can choose, unlike the insurance company, I can choose which stock I want to insure against. That's my choice. So I may choose not to insure a company which I feel is very volatile. And that is what gives me an edge in case of stock insurance as compared to the other stocks. So I insure AAL, but I should not insure all my money for AAL. I should insure maybe Bank of America, which is running at $26 today. I can insure it against it falling below $25 and collect premium for it. The American insurance, for example, Bank of America premium may be less in percentage term, but more stable than Wells Fargo. Maybe I could insure against some other companies, similar companies, and so on and so forth. What I do is, by diversifying, if I insure, let's say, 100 different stocks, or maybe 10 different stocks. Out of the 10 different stocks, one of them may fall below, let's say in this case, 11. It happens. It happens to me. It happens all the time. What does happens if it falls below $11? It's not that very catastrophic. All you do is you get that share allotted to you, and which is not bad. I could have bought this share at $13. Now I am buying it at less price. So unless it has become totally bankrupt, owning that share is actually good for me, because I own that share at lower price. And once I own that share, I keep that aside. And then at that point of time, I have two options. Maybe let's say it goes to, let's say, $10. I can just sell it to market, take $1 profit, but on the next other 9 companies that I insured against, I made a profit. So this gets balanced against it. Or I can keep that share and then stay with me and wait for it to come back to that price, $13 again, and then, or maybe $11 again, from 10 again it comes back 11, and then sell it. Or even better, I can do some strategy called call sell, and that will be another video where I will make money, a premium money, against the stock that I own. So the call sell is another strategy once I get the share allocated to me. So to recall again, You are insuring a stock against the steep fall. You expect the stock not to fall, or only few stocks will fall against amongst the a basket of different stocks that you are insuring against. That's how you make money in stock insurance and using the put sell strategy. I want, if you are into if you are not still not clear, I will advise you go to finance.yahoo.com, open AAL, then go to the tab that say options, then drop down and select the strike date. The strike dates are weekly: August 14th, August 21st, August 28th. Select one of the next week or next to next week strike date. Then go scroll down below, look at the put. There's the put sell. Look at the strike prices that are a little below the current stock price and see what the premium for that strike price is. And think about it. Would you like to acquire this stock at this price? Are you comfortable if the stock gets allocated at that price? And if you are not allotted that price, you are collecting that premium. In a in a in a insurance strategy, you actually, and that's what strategy my strategy is, I actually don't want to own that stock. I usually I'm concerned only about collecting the premium, and that's what happens most of the time, 90% of the time. But once in a while it does go, the stocks does fall steeply and I get that stock allocated, and in that case I'm okay with the stock that is allotted to me. I keep it. I typically keep that stock, wait for it to price to recover, or I sometimes also do a call sell. The call sell strategy I will cover in another video I already have made. Now there are a few more points I want to you to be aware about, is that you start insuring when the stock has already fallen from its peak a little bit. Don't try to do a put sell if the stock is very high already. For example, Amazon, it's already very high at 3300. There is a chance it can go down steeply because it's already very high. That's what I feel. I mean, that's how you should also feel. When the market is very peak, that probably is not the best time to do this business. It's already very high. There is a chance that the stock will fall down. For example, the currently the S&P 500 is close to 3300. That is not the time you start this business, this insurance business. Stock is already very bubble. Wait for the market to cool down to something like 26, 2700, maybe 2800 at least, and at that point of time you start this business. That is not the time. So that's one thing you must keep in mind. Acquire the stock if it goes too low. You acquire, so that's the strategy. Now, there is another point you need to keep in mind. What are the risk factors in doing this business? Let's say you are insuring a basket of 10 stocks against this steep fall, and the whole stock market goes down. That's something that happened around March 23 this year, right after the coronavirus struck. The whole market went down. S&P index went down to 2300. Now, if you had insured, and that steep was that fall was very steep. If you had all those insured 10 stocks, maybe you have 8 out of 10 would have been in your bag. You would not have collected premium, but all those stocks would have been in your basket. So probably that is also okay, but you have to be prepared for that. This is not, sometimes it may happen that the whole stock market will go down. You will get all those stocks allocated and you have to be prepared for that. Probably that's not the scenario you want. That's why another reason I'm saying, be wait for the time when the stock market has cooled down a little bit. It's not overly high, or when it's high, try to do less insurance only for the stock that has gone down already. That's some second thing in your mind. but you can do it comfortably if the market is down from its peak something like 10%, because it's already down from the peak to 10%. And then by doing the insurance you will acquire the stock by, like in this case it's down by like 20%, and then you are acquiring it, so you are acquiring the stock at 30% from the peak, or from the 30% down from the peak, which is not a bad entry point if you have to acquire that stock. So that's how I look at it. uh, I try to insure a stock when it's already low from its peak. If it's near its peak, I usually stay away from it. So the example could be, for example, AL is one such example when it's down from its peak. For example, Bank of America, it at peak it was much higher, but it's substantially down. It's still good. It's still a little high, but it's still substantially low from its peak. So at like 25 or so, I can do insurance for that stock. I do not insure against the stock. For example, AMD, it's a good stock, it's going high, but it's already very high and there's a chance it can go high. So I don't want to insure that stock against that steep fall. So those are the kind of things that you need to keep in mind when you are insuring a stock. Um, yeah, the last point, better to insure when the stock as a whole is already a bit down. Coronavirus has provided an opportunity to still invest in this market, in the sense that there are two classes of stock. One, the classes that the stock that are already very high, and there is another class of stock that have been affected by coronavirus, but there's a good chance that they will recover. So you can probably start insuring those stocks that are down now. And then if you probably will acquire those stocks that will be a double down, which means that they are already down, they will be further down, and you will acquire at that point of time. So you probably are okay even if you have to acquire it. If not, you keep collecting the premium. So this is what my strategy, and I have benefited for it. I wanted to share my knowledge with you, and I will at some point of time, again as I see, share my experience, my profit in the stock market, making money out of the put sell. I hope you understand it. If you have any question about it, any example of the stock that you want to understand it with, send me your comments in the comment section, and I will explain that in another video, your questions, if I feel like, or otherwise I will reply to that. I hope this is helpful for you. If you subscribe, you can get more such videos from me. Thanks for taking a look.